everyone. I'm Joel, your host for Talking Trends, where we explore trends in real estate and other luxury lifestyles here in the greater Sarasota area. Today, we're going to talk about insurance, and we have a special guest, Nick Cirillo, President of Sales for Alliance Insurance of Sarasota. Welcome, Nick.
Thanks for having me, Joel. Appreciate it.
Great to have you. So before we kind of dive into the big topic of insurance, why don't you just tell us a little bit about yourself?
Yeah, I graduated from Florida State University back in 2000.
We won't hold that against you.
Yeah. Well, you Gator fan?
Maybe.
Okay. I graduated. Go Noles. 2014. My parents have been in insurance for over 35 years. So they were all state agents for 25 of those years. When I graduated, I just naturally kind of flowed into the business. Wasn't what I was set out to do, but was just kind of get into the job world scene, if you want to call it that, and try to find something that I really enjoyed. But after that, I ended up never leaving. It was my mom and dad's business, kind of built it up with them. That was back in 2014. So it's been over 8 years now that I've been in this world, and I love it. It's a great job.
So again, hot topic, insurance these days in Florida. Of course, we're in this kind of post-Ian and post-Nicole storm situation. And so there's lots of question marks about insurance. So, I mean, just kind of at a high level, can you kind of give me a feel for what the state of the insurance market in Florida?
Yeah, I mean, what we're seeing before, I'm just going to take it before the storm and then after the storm. Before the storm, we already had problems in the marketplace. I'm sure a lot of people know now there were 6 companies that went out of business just this year in Florida. None of them were of high value or high net worth capacity, but that in turn does put pressure on high net worth carriers in the overall marketplace. When you have companies in general that are going out of business, the overall state before the storms was that guidelines were extremely tough. Rates on average were going up 30 to 40%. And it's a difficult conversation to have because most people think of insurance as, just kind of like a stable market and things shouldn't change. But I'm like, you look at gas prices, food prices, it's hitting pretty much every sector and industry out there. So insurance is in that same boat.
And it makes sense. And I like you said, pre-storm, I've had a number of clients who would call me and say, Joel, my insurance just got canceled. Right. Where do I go? So like you said, it's kind of, that's what was happening, brewing already almost in the market before the hurricane.
Companies not even going out of business, instead shedding, 20, 30% of their book. They're calling it exposure and risk management. So they're de-risking in areas where they feel that they have an oversaturation of policies that may be too close to the coast, too high in a certain zip code.
So obviously, even pre-storm, there were some issues in the insurance market in Sarasota, in Florida in general. Now, post-Ian, post-Nicole, what's kind of happening? Yeah,
so as soon as the storm was making its way towards Florida, as is always the case, the market shuts down. So we expected that. But the problem was it never really reopened. After Ian, that was arguably the biggest storm, most costly storm to ever hit Florida. Those numbers will come out eventually. Wow. But as that storm came and went, people in insurance were expecting, a week, maybe 2 weeks afterwards that the market would come back, and open up just as normal. It hasn't. I would say about 90 to 95% of carriers have not yet reopened business for the state, or they have some sort of closure, whether it's a county closure, zip code closure. So we have not had the ability to really remarket everybody or really write business for clients with new closings. I have a ton of people calling me saying, hey, I'm closing on this condo or this house, and we can't really explore their options in the normal marketplace. So that started to trickle, and then Nicole came. So we had a couple companies that actually had been closed for about a 4 or 5 week span, which was the longest that I've ever seen. And then Nicole came, and now they've yet to reopen.
They're kind of taking a step back, right, and trying to just evaluate where they are post-storm. Is that kind of why they're kind of frozen?
Yeah, the thinking is that they have an influx of claims. They're extremely inundated. They're using all of their manpower, employee-wise, and pulling all people from underwriting, into the claims department, trying to facilitate as much manpower to claims, because that's ultimately where it's needed the most. They want to get those claims closed, people paid, get back on their feet. And I just don't think that the new business, especially being the end of the year, it makes sense that they've already probably hit capacity in a lot of ways. So they're not trying to over inundate themselves with business.
So just generally availability, right now, you're very limited?
Very limited. Yeah, I would say there's, in the high net worth sector, probably 2 to 3 companies. And it was already a tight space to begin with. And Chubb is one of the biggest writers, globally. They have shut down with wind in Florida. So anybody buying a house that has a mortgage, you're not going to be able to go to Chubb.
Right.
You'd have to go X wind terms and then buy wind through another provider, which isn't ideal. I mean, it can still be done, but the typical package where you get your home, your auto, umbrella, everything done with one company, Chubb isn't doing that at the moment. There's no saying when that's going to lift. They're a massive company. So for them to kind of lead the pack on that, it's going to trickle out into other companies like AIG, Vault, Pure.
And so we're kind of, I mean, our general discussion is kind of on the luxury end of the market, the higher end of the market. I mean, what about the lower points of the market, the under $1 million value
under $1 million. I mean, a lot of the chatter that you're going to hear out there is Citizens. I personally don't really write for them. We can, but we just choose not to. It's an inferior policy in many ways. It is not doing the client a justice. Now, if premium aside, policy-wise, you can get a much better policy in the open market. Now, what we're seeing is the premiums out there. What's the premium? You know, if the Citizens policy is $2,000 and the next best rate is $3,500, most people are going to take the $2,000, and it's understandable. You never really had that competition. Citizens was not meant to be the go-to. They were a last resort company built for people either with, you know, multiple claims history, couldn't find another company to write them, et cetera. Now you're seeing a lot of people that are, let's say, not with Citizens, go to Citizens, or if they're not with Citizens, they're on the open market because their rate went up 30-40%, which is, like I said, the average, and they're upset. As an independent agent, I'm able to re-quote them through about 30 different companies when the market is normal. It's not normal right now, but normal market conditions, I would say the fact that I haven't been able or haven't needed to write Citizens is just a testament to there's enough companies out there still writing at a competitive price, and you can get it done.
And that's probably one of the most important messages. It still can be done.
Yes.
You know, it's in my mind, the market is all the market forces are in place, right? For insurance, they're trying to figure out, you know, the cost and risk and all those things, and they're taking a step back from it to really understand that. And of course, I work with you a lot. I work with other insurance companies as well, and it's the same thing. Everybody says there needs some time to kind of assess the overall situation before they're going to dive back into the market. But there's still availability. You know, we've been very fortunate. We've closed quite a few transactions since Ian. Even on the super high end, it just takes a little bit more work to make it happen. And the practical side of that too is we even in transactions now we're insurance is becoming a contingency, which we didn't have that historically.
I've never heard of that.
So it's a new insurance rider for the contract. Again, just become a practical question. I'm going to make sure buyer can get insurance at a reasonable rate. So you know, obviously, I think you kind of hit, you know, talking about it's kind of an open book at this point as far as rates and prices and everything. And I think you said even before storm, we were seeing pressure on probably rates already. So crystal ball feeling about rates in general?
It takes, so like when you see these rate increases now, those are factors that were priced in from last year. So it takes a while for them to file with the Office of Insurance Regulation, go to the state and say, hey, you know, we want to file for this rate. There's only so much that they can file for. But the reason why it tends to be for our area 30 to 40% more is because the statewide average is around 15, but pockets end up being 30 and 40%. You know, South Florida, like I said earlier, Miami-Dade, Broward, Palm Beach, it is not uncommon to see 80 to 100% in 1 year, one renewal. No change in, you know, claims history, no change to the insured. It's just strictly the insurance company saying we have to get adequate rate for this because they're constantly getting an influx of data. And with the storm, it's just going to bring the same thing. So if they're not charging the right premium and they're in the red, that's why you had 6 companies go out of business. They can't be like that.
I think there's always been a question mark really about, you know, whether it was artificially low almost, the cost of insurance historically.
I'd like to talk about that. So there was a 10-year span. So it's pretty cyclical in Florida. You can look back in history, 10-year span, I think it may have been 11, that we didn't get hit by a hurricane. So you had from, I think, 05, 06, a 10-year span. And in that time frame, you had a lot of startup companies coming into Florida, getting business, charging the lowest rate. It was like a competition of sorts. They wanted to get the lowest rate out there to garner the most business. And in doing so, you had companies that hadn't been around but just 4, 5, 6 years, had a lot of business on the books, and they were undercharging premiums. So once things started to go south, weather-wise, or just factors in insurance and in the marketplace changing, you got a lot of roofing fraud, other factors that change things. These companies are paying out big money in claims, and they're realizing that $800 rate that they were charging someone for home insurance was far below what their rate should have been. And now you've been seeing for really about 3 to 4 years, just rates slowly ticking up. And then I've been telling clients it's like a rip off the Band-Aid moment this past year. You're seeing like that one massive increase, whereas the prior years it was like 10, 15%, which was okay. They could swallow that, but the phones have never rang so much on a 30 to 40% on average. It's just crazy.
I guess a question I haven't really focused on too much, but also we have to realize, right, that the value of properties has
changed a lot,
changed drastically in the last couple of years, right? And so
the cost to build, labor, materials,
right? So that's another factor, which almost we're talking a little bit about it. Almost have to tell your homeowners to look at their policies again because they may be underinsured as well.
Right. So like insurance is so variable that like when we get asked, what can I do to lower my premium? There's so many variables in that policy that it's impossible to talk about it in 2 minutes. But one of the things that the companies are doing, just to give some consumer input, they're automatically increasing the dwelling coverage on majority of policies by an inflation rate of 2% as high as 16%. I've seen with one carrier. So they are taking, like I said, that data in and knowing that they're paying out claims and seeing how much labor and materials are costing these days. They can't afford to insure that same house for $400,000 or $1 million, whatever it is, for the next term. They have to be smart about it with the consumer as well.
Start building that in. And just in that context, we talk a lot about the cost of insurance and the age of things and those types of things. So are there really proactive things that can help reduce your insurance rate? And I guess the flip side of that question is, insurers, do they get to kind of choose their own, I only want roofs that are this old, and so they can have their own criteria for a homeowner?
Yeah, that's been the topic that's been coming up recently in terms of legislation. They're talking about what can and can't be done for specifically roofs. That's been the hottest topic all year long. Roof guidelines have never been stricter. We're seeing, tile roofs be typically in the 20-year range. Once you get above 20, you're either getting an actual cash value policy for your roof specifically, or, you're getting into the 3 or 4 or 5 companies that still offer you replacement cost. And it's just, what's their rate? Other factors for like shingle roofs, 15's been the unanimous cap, with, again, a few companies still going to 20 and, metal 20 to 30. But it's definitely tough. And they can pick their own guidelines. And there's companies much more strict than that.
And that's what's been really interesting in the market, of course, even again, not even reflecting on the storms themselves or anything, but we saw that a lot in the market, 20-year-old shingle roof. I mean, it may be hard to even get insurance on it. And so actually the cost of a roof gets starting to be factored into each deal, almost to a certain extent. So buyer and seller are having to deal with it one way or the other.
I'd have to imagine you're buying a house, you see the roof age 17, 18 years old. Most people are getting inspections done. And then that's cause for concern, just because I think now the consumer is pretty savvy in terms of what to look for in insurance. And that's been the absolute number one thing, is the roof guidelines.
And other mechanicals, we mentioned water heaters, anything else that?
If the house is over 30 years old, we'll call it 30 years old. Most of the time it's requiring a 4-point. So the main things that they're looking at there is the electrical age, so your main panel, the water heater, the plumbing, the roof, and then the HVAC unit. Those are the 4 main.
And so how many years was that, you said?
Usually 30 years.
30 years, okay.
Companies can vary, but I would say at 30, that's a good starting point. If you're getting an inspection done for the home, get the 4-point done. It usually costs like an extra $75 to $100, and it's really beneficial.
And we do that pretty much, we just...
you guys always do.
Anytime we do it, we just do it to have it, because it could give them also some credits, right? If stuff was done.
Certain credits can apply, just different companies. The biggest way for the consumer to save on their insurance would be that wind mitigation report that we've discussed so many times over the years. But that's really heavily looked at: the roof, the way it was tied down, nailed down, what type of barrier was put down, the age of the roof. There's a few variables there. And
in that context, because I was always confused in this when I was looking at it. I mean, if a property is not so many years, so like 10 years old, you don't necessarily have to get a 4-point, right? You probably still want to get a wind mitigation, right? And know what credits you could get. But sometimes it seems like it doesn't matter. If it's 5 years old, we don't need anything.
Yeah, usually the benchmark for as long as I've been in the business is 2002. That was the year that the building code changed substantially. No companies ask for a wind mitt after 2002. Now that has changed to some degree once you start getting into like what's called the excess and surplus lines market. Some companies will ask for a wind mitigation report just to verify certain things. But for the standard market, a wind mitigation report is usually not needed on a 2002 built post home. So anything 10 years and newer, 5 years and newer, the only reason that that could possibly be warranted is if the house has impact glass windows, but the company doesn't automatically give that credit.
Gotcha.
That's the only time that you
because that was, I think, always my confusion, because sometimes it seemed like they always just automatically gave the credit.
Yeah.
And you didn't really need to go get it. So
It just depends on the county.
even if the windows weren't impact.
Yeah. That's the thing. So like it was a county thing. So for building codes in certain counties, they would just automatically take that and run with it.
Yeah. And so we went into our team and asked if they had any questions. And so some of this is coming from them. Any difference in insurance rates between a primary residence and a secondary residence?
Usually like 10%.
10%. Okay. Yeah. So
and that can vary. I mean, some companies will say there's no difference, but on average, it's about 10%.
Okay. That's interesting. And do you just look at whether it's homesteaded in Florida, basically? Is that your driver?
Usually homestead is a big one. The number of months occupied, typically if let's say you're here 9 months or more out of the year, it's going to be your primary on paper.
Yeah.
As far as the seasonal goes, sometimes it can change the eligibility. With certain companies, you might have to have an alarm system monitored. You might have to have a guarded or gated community. So there's some other factors that could come into play once it goes outside of primary.
Yeah, gotcha. And so it's interesting. I mean, just kind of crystal ball again. So looking forward, you're probably going to see a much more strict perspective from the insurance companies, correct, about what they will accept and not accept as far as many of these mechanical factors.
Right. I'm thinking that the roofs are going to continue to get more strict because this was really a big phenomenon this year. But those companies that were still taking, let's say, a shingle roof at 20 years old are probably going to tailor it back to 15. I could see everybody going to a straight 15 threshold. It's just my guess.
Gotcha.
And then other items, they've already been picking out water heaters. If it's in the garage, if it's tankless, if it's not tankless, all those things do come into play. But most of the time on a water heater, if it's inside your home and it's 15 years, they're going to ask you to replace it. If it's in the garage, less risk, for damage. Obviously, it's in the garage. They may go 20. It just depends.
But any other things we should cover in the kind of what's happening in the market now, or any more predictions you have for what's going to happen in the next year?
I would really just say the rest of the year here, we're in November, it's probably just going to be a wash. You're not, anybody that has a renewal coming up in the next 2, maybe even 3 months, it's likely that you won't have a good opportunity to move the business. So depending on what your rate is, I would still recommend, looking it over. If it went up egregiously, call and see what's out there in the market. But once the first quarter of 23 hits, I think you're going to see a lot more stability in terms of who's going to be the players in the market, where they're going. Everybody has like a guide plan for the following year in place at that point, and it kind of resets the table. They have what's called reinsurance. It's the company's insurance for themselves, just like we buy insurance. And their reinsurance partners are going to be dictating what they can and can't do. It's not so much the company. And I think that's the biggest misconception. It's that the company is running their business the way that the reinsurers are telling them. Because if they can't get reinsurance, they can't be in business. Their hands are tied to some extent. And that's going to be, from what I'm hearing, the biggest factor moving forward.
Yeah, interesting. And you talked about Chubb, obviously, who covered a lot of that's kind of on hold now. And the other more luxury end of the providers, I mean, they're still... I've got Vault personally. Vault is an exceptional company. They're up there with the likes of Chubb, AIG, Pure. They're the best company out there in terms of, claim service. They can package all of the business together, just like Chubb and AIG. They're still writing. So that's the good news. AIG, about 2 years ago now, they kind of led the pack on this in terms of really shutting down Florida. They would still write Florida, but they required a lot of premium. And they had to have a separate home outside of Florida, not in one of like the California, New York states, like all the hot states where people typically had a house. So they still are writing in Florida, but again, it's very difficult. But right now, I would say the high net worth market would pretty much be dwindled down to Pure, Vault, and AIG if you can get access to them. Interesting. And we were talking about a little bit, we just closed on a significant property. And again, it took us some finagling to get it done. And it was part of that. They had to kind of put their portfolio under that insurance company to make it work. So
the days are definitely gone. You will not get what's called a monoline piece of business written in the high net worth world with one of those companies. They just won't do it. They're going to have at least 3 to 4 lines typically. So a home, auto, and umbrella is the most common. Most people in that sector are going to have, some fine arts, some jewelry, things of that nature. And then it can kind of just expand from there if they have multiple houses.
Yeah. Interesting. Awesome, Nick. It was great having you on the show. We really appreciate it.
Absolutely. Thank you so much, Joel.
Absolutely. This is Joel with Talking Trends. We'll see you next time.